Your ability to recognize and identify the liquidity zones is essential for profitable trading Forex. In this video, we'll discuss 7 types of liquidity in Forex trading every SMC trader should know. Please don't forget to like this video, subscribe to my YouTube channel, and let's start. And first, let's discuss what is liquidity zone and why it is so important. Always remember that even the highly liquid market like Forex does not have a constant stable liquidity. The trading orders, the clusters of trading orders tend to concentrate on specific price levels, while some price levels will lag the interest of the market participants. The clusters of price levels with the high concentration of trading orders will be called the liquidity zones. And here are the main types of liquidity zones that you should know. The first type is the liquidity based on Fibonacci levels. The zones based on Fibonacci levels can concentrate the market liquidity. Classic Fibonacci retracement levels 382, 50, 618, 786, Fibonacci extension levels 1272, 1414, 1618 attract the market participants and the liquidity. Take a look at the price action on a dollar CAD pair. Here we can spot a perfect example of a liquidity zone that is based on a 618 retracement of a major bullish impulse. We can see that many times in a row that zone was respected by the market. From that zone, we saw significant bullish movements, and it indicates that liquidity concentrates within that zone. Also, there are specific areas on a price chart where the Fibonacci levels of different impulse legs will match. Such zones will be called Fibonacci Confluence Zones. Look at this perfect Fibonacci Confluence Zone on New Zealand dollar pair. We see a perfect match between 618 and 50 retracements of two major impulses. And look how perfectly the price reacts to that area. You can see that that area is the magnet for the price. It signifies that a lot of orders are placed within that area. Fibonacci confluence zones will be considered to be very significant liquidity zones. The second type of liquidity zones is based on psychological levels. Psychological levels and the round numbers quite often concentrate the market liquidity. Look at this psychological level on WTI crude oil. 80.0 is a very significant price level for the market participants. It is based on round number, and for that reason, many times in the past, the market reacted to that level. We saw strong bullish and bearish reactions to that level. Get free Forex trading signals and exclusive analysis. Subscribe to my free Telegram channel now. The link in the description below. It definitely composes the liquidity zone that attracts the market participants, and the market participants are placing their orders within that area. The third type of liquidity is based on volume analysis and volume-based zones. The analysis of market volumes with different technical indicators will reveal the zones where the trading volumes concentrate. One of such indicators is volume profile. Look how I analyzed and recognized the liquidity zones with the volume profile indicator on silver. Volume profile indicates the concentration of market volumes on different price levels. Volume spikes will show us the significant liquidity zones, and the price action on silver clearly confirms the significance of these liquidity zones. Type of liquidity number 4, the historic zones. Historic liquidity zones will be the areas on the price chart based on the historical price action and historically significant price levels. Market participants pay close attention to the price levels that were respected by the market in the past. For that reason, such levels attract the market liquidity. Here on silver, you can see the example of a historically significant liquidity zone. Even though the market is bullish, even though the market is trading in a bullish trend, once that liquidity zone was reached, the market stopped growing, and after 2 attempts to violate that area still holds. That will attract the market orders, and sellers will start placing their selling orders there, and their actions will form the liquidity zone. Type of liquidity number 5, trendline based zones. Quite often, historically significant rising and falling trend lines will compose the liquidity zones. Please note that the trendline based liquidity zone will be also called the floating liquidity zone because it moves with time. Look at that rising trend line on a pound yen pair. It proved its historical significance, and many times in the past from that trend line we saw significant bullish movements. The market participants will notice that, and they will start placing their buying orders based on that trend line. that will attract the liquidity. It will lead to the concentration of trading orders based on that trend line, and that will form the liquidity zone. Type of liquidity number 6, technical indicator based zones. Popular technical indicators may attract the market liquidity. For example, universally applied moving average can concentrate huge trading volumes. Here in Euro Yen we have a commonly applied simple moving average with 50 lengths. That moving average proved its significance, and many times in the past that was respected, and we may assume that in future the market participants will place their trading orders based on that trend line, and it will form the liquidity zone. Similarly to trend line, the moving average based liquidity zone also will be the floating liquidity zone. Type of liquidity number 7, confluence zones. Confluence zones are the liquidity zones based on the confluence of liquidity zones of different types. For example, it can be a match between historic zones, Fibonacci zones, and volume zones. Such liquidity zones are considered to be the most significant. Look at that crucially significant liquidity zone on US 100 index. That liquidity zone is based on the psychological level 17,000. It is based on Fibonacci retracement of the major bullish impulse. It is based on 618 retracement. Analyzing the volumes with the volume indicator, we can also notice the spike of volumes when the market tests that area. That zone is crucially important for the market participants, and in future when the price will approach that zone, we will most likely see a strong reaction to that zone. Always remember a simple rule: the more different liquidity zones match within one single area, the more significant is that confluence zone. Remember that your ability to recognize the liquidity zones, especially the significant ones, is essential for correct predicting the future market behavior and predicting the market reversal. Liquidity zones are also one of the core elements of multiple trading strategies. Its identification and recognition is the absolute basics of technical analysis. Learn by heart the liquidity zones types that we discussed today and learn to identify them properly. Let me know, traders, in the comment section if you have any questions. Also, traders, if you want to learn how to trade, as always, do not forget to check my premium group. For more info, check the link in the description below. Also, traders, do not forget to watch my other videos.